Banks don't actually want you poor. That probably sounds backwards. After all, if someone has no income, no savings, and no access to credit, they're not a very profitable customer. Lending money is one of the core ways banks make money, but only when the borrower can realistically pay it back. So if banks aren't trying to make people poor, what are they optimizing for? I spent years working inside banking, and in the next few minutes, I'll show you how many lending decisions are designed around one simple idea: balancing risk with profitability, and why understanding that can completely change how you think about debt.
I'm not going to tell you my name, the bank I worked for, or my exact role. What I will tell you is that I spent more than a decade around the teams that built and refined lending policies, customer risk models, and credit strategies. One thing surprised me more than anything else. Most people think banks ask a simple question: will this customer repay the loan? In reality, that's only part of the equation. The other question is, if we lend to this customer, what does the relationship look like over time? That distinction explains a lot about how modern consumer lending works. Here's the mental model many people have. Banks make money when customers repay loans. That's true, but it's only part of the story. Different customers generate revenue in different ways. Some pay interest on outstanding balances. Some generate transaction fees when they use their cards. Others purchase mortgages, investments, insurance, or other financial products. From a lender's perspective, the most valuable long-term relationships often come from customers who borrow responsibly, continue using financial products, and reliably make their payments. Not customers who immediately default, but not necessarily customers who never borrow either. Take credit cards as an example. If someone pays their statement balance in full every month, the issuing bank may still earn interchange revenue from merchants, although interest income is little or none. But if another customer occasionally carries a balance while continuing to make payments on time, the bank may also earn interest on that balance. That's why lenders spend so much effort trying to understand not just whether you'll borrow, but how you'll borrow. And that's where the system becomes much more interesting. So how does a bank decide how much credit to give you? Most people assume a credit limit is simply a reward for being responsible. Sometimes it is. But from the bank's perspective, it's also a business decision. Credit limits are typically determined using models that estimate both risk and expected profitability. Those models consider things like your payment history, income, existing debt, credit utilization, and many other factors. Different lenders weigh those factors differently, but the goal is generally the same: lend enough to make the relationship worthwhile without taking on more risk than they're comfortable with. That's why you might receive a credit limit increase without asking for one. It isn't necessarily a sign that someone at the bank thinks you deserve more money. More often, it's a signal that the lender's models now estimate you can responsibly manage additional available credit. Whether you actually use that extra credit is still your choice. And that distinction matters, because one of the easiest mistakes people make is interpreting more available credit as permission to spend more, when in reality, it's simply another financial tool. Now let's talk about something almost everyone has seen on a credit card statement: the minimum payment. People often assume it's the amount the bank believes you should pay. It isn't. It's the minimum required to keep the account in good standing under the card agreement. If you only make the minimum payment while carrying a balance, repayment can take many years, especially on larger balances with higher interest rates. During that time, interest continues to accrue on the remaining balance. That's why paying only the minimum can become so expensive. The minimum payment isn't designed as a financial plan. It's simply the contractual minimum needed to keep the account current. But here's the part that surprised me when I first started seeing these models. The interest rate isn't always the first thing lenders pay attention to. And your credit limit isn't the whole story either. There's another metric that often provides an early signal about changing financial behavior, sometimes before a single payment is ever missed. Understanding that number helps explain why some people suddenly receive balance transfer offers, debt consolidation promotions, or changes to their available credit seemingly out of nowhere. We'll get to that in a moment, but first, there's one misconception about banks that I think actually makes it harder for people to protect themselves.
One thing I want to be careful about is how we talk about banks. It's easy to imagine a room full of executives asking, "How do we keep people in debt?" In my experience, that's not how it works. The conversations are usually much less dramatic and much more analytical. Teams look at default rates, customer behavior, regulatory requirements, profitability, retention, risk. They're trying to answer questions like which customers are likely to repay, which products meet our risk targets, how do we price this portfolio. No single person has to decide to trap anyone. Instead, thousands of small business decisions, each made for understandable reasons, combine into a system that encourages certain behaviors and discourages others. That's important to understand because systems don't need bad intentions to produce outcomes that aren't always in your best interest. Once you recognize that, you stop looking for villains. You start looking for incentives. And incentives are much easier to understand and work around.
Earlier, I said there was one number that often tells lenders more than people realize. It's called credit utilization. That's simply the percentage of your available revolving credit that you're using. If your total credit limit is $10,000 and your reported balances add up to $2,000, your utilization is 20%. Why does that matter? Because, over time, changes in utilization can provide useful information about changing financial behavior. If someone's utilization gradually rises from 20% to 40% to 60%, it doesn't automatically mean they're in financial trouble. People use credit for all kinds of reasons. But statistically, sustained increases in utilization can be associated with higher credit risk across large groups of borrowers. That's why utilization is one of many signals lenders monitor when managing credit portfolios. It can influence future lending decisions, credit line reviews, and the types of financial products or offers you receive. The important point isn't that banks are watching you personally. It's that automated systems continuously evaluate millions of accounts using patterns that have historically predicted future outcomes. Most people don't realize they're sending those signals every month.
So, what should you actually take away from all of this? First, remember that credit utilization is one of the few factors you can influence fairly quickly. If you pay down part of your balance before your statement closing date, the balance reported to the credit bureaus may be lower than if you wait until the payment due date.
Depending on your issuer's reporting practices, that can reduce your reported utilization. It's a small timing difference, but it can change the picture your credit report presents. Second, don't treat a credit limit increase like free money. A higher limit can lower your utilization percentage if your spending stays the same, which may benefit your credit profile. But if the higher limit leads you to spend more than you otherwise would have, that advantage quickly disappears. Think of a higher credit limit as additional flexibility, not additional income.
Here's the mindset shift I wish more people made. The minimum payment isn't a goal, it's a safety line. Paying only the minimum keeps the account in good standing, but it also means balances can remain outstanding much longer, increasing the total interest paid over time if you're carrying a balance. Whenever it's realistic for your budget, paying more than the minimum reduces the principal sooner, which generally reduces the total interest you'll pay over the life of the debt. That doesn't mean everyone can do it every month, but understanding what the minimum payment represents helps you make a more informed choice.
When I worked in banking, one lesson stayed with me. Most financial systems aren't built around individual stories. They're built around patterns. A model doesn't know why someone used more credit this month. It only knows what similar patterns have meant across thousands or millions of previous accounts. That's not personal. It's statistical. Understanding that changes how you see the system. Instead of asking, "Why did the bank send me this offer?" you start asking, "What information might my financial behavior be communicating?" That's a much more useful question, because once you understand the signals, you can decide which ones you want to send.
If this helped you understand the system a little better, consider subscribing. There are plenty of parts of consumer banking that make much more sense once you've seen how lenders think about risk, pricing, and customer behavior. In the next episode, we'll look at a question that surprises a lot of people. Why can your interest rate change even if you've never missed a payment? Or maybe you'd rather dive into credit scores, soft inquiries, or pre-approved offers. Let me know in the comments which topic you'd like to see next. Until then, don't just look at the offer, learn what signal it's responding to.